Let's dive into how loan defaults can be avoided while investing in cryptocurrencies. It's like a balancing act between risk and reward, right?
Absolutely. And the key is managing that balance. The idea that even though crypto investments might be super profitable, taking loans to fund them adds an extra layer of complexity.
Exactly. You know, it's like if you borrow money to invest, you're not just dealing with market ups and downs, you're also on the hook for fixed loan repayments, regardless of your
Yeah,
performance.
right? And that's what makes leveraging so tricky. If the market dips unexpectedly, you risk not being able to cover your loan payments. It really highlights why a structured repayment strategy is a must.
Yup, structured repayment is a lifesaver here. Imagine setting up automated payments, responsibly rerouting a portion of your returns to debt repayment while also keeping an emergency fund. Hey, it's the kind of discipline that isn't always easy to maintain.
Yeah, and it's fascinating how the advice stresses having both an automated payment system and reserving some returns specifically for debt. It's like your financial safety net is always ready.
Right, it really is. And another thing, diversification. Not just within crypto, but also across other asset classes like stocks, bonds, or real estate. This way, you ensure there's enough cash flow to fall back on if things go sideways in the crypto
Exactly.
market.
And that's crucial when, say, the market goes through its notorious volatility. Crypto can swing hard in a matter of hours. So diversifying can really protect your overall financial health.
Absolutely. Imagine it like not putting all your eggs in one basket, even when those eggs might be golden. Diversity can really buffer the strain, especially when you're on the hook for loan obligations.
True, too many eggs in one basket can lead to a scramble if one drops, or in this case, if one asset tumbles. It's a simple analogy, but it fits perfectly.
And then there's the whole point about being cautious with margin loans or other high risk borrowing options. It's like borrowing against your investments on margin, which can be incredibly tempting, but the risk of forced liquidation is very real.
Right? And if the asset values drop sharply, the exchange could force you to sell at a loss, which leaves you in a pretty tight spot. That's a critical reminder for anyone considering high leverage strategies.
Totally. And it goes hand in hand with setting clear investment goals and having limits. You really have to know what level of risk you can tolerate. It's like setting a budget for how much loss you're willing to weather.
Exactly. You don't want to be so caught up in the excitement of potential gains that you overextend personally. Maintaining boundaries and sticking to them is crucial, especially in such a volatile environment.
hmm And here's an interesting point: the need to avoid emotional investing. Data-driven decisions are the way to go over a gut reaction in these scenarios. You can't let market hype override solid rational strategies.
True, it's like you have to keep a cool head and rely on facts and stats rather than jumping on every trend that comes along. Otherwise, you're simply inviting disaster when markets shift abruptly.
Yeah, exactly. And a bit of a challenge, you know, sometimes it might sound like being overly cautious can hold you back from seizing opportunities. But honestly, staying data-driven is what saves you in the long run.
I get that. But I do wonder if being too conservative might cause you to miss out on potential gains. Would you say there's a risk of playing it too safe?
Sure, there's always that trade-off. But when you're dealing with loans and mandatory repayments, the cost of missing payments can far outweigh the benefits of chasing every opportunity. It's a calculated risk, you see.
Yeah, that makes sense. Because if you go overboard, one misstep could mean defaulting on your loan, which then spirals into bigger problems. It's a tough balance.
Absolutely. And another interesting tactic mentioned is using stablecoins as a buffer. Since stablecoins are pegged to fiat currencies, they provide a bit of stability amidst crypto volatility. It's like having a financial anchor.
Right on. By holding part of your capital in stablecoins, you essentially keep a reserve that isn't affected by the wild swings in the crypto market. It's a pretty neat strategy to ensure liquidity for loan payments, yeah?
Exactly. It's like having a cash reserve in an otherwise unpredictable sea of digital assets. And then, there's the benefit of monitoring market trends and regulatory changes closely. Keeping up to date means you can pivot when needed.
Right. Policies and regulations can impact how you trade or even the value of your crypto holdings. Being informed enables you to adjust your strategy before things get too out of hand.
And let's not forget about employing risk management tools like stop loss orders. It's like having a safety net to automatically minimize losses when prices hit a predetermined low.
Yes, stop loss orders can prevent too much downside if a market crash hits, giving you the breathing room needed to cover your loans without having to liquidate everything at a loss.
Exactly. And these strategies together form a holistic approach, a balanced portfolio that includes crypto, stocks, bonds, and even real estate, ensuring that if one sector tanks, you're not left hanging.
Right. Diversification is the name of the game here. But I have to ask, do you think the current crypto landscape, with its projected growth, is making investors too complacent about these risks?
That's a great question. On one hand, the projections are enticing, like the market's expected to almost double by 2028. But on the other hand, that success might lull investors into a false sense of security. It's almost like they think the gains are guaranteed, which is clearly not the case.
True, the numbers can be misleading if investors don't fully consider the volatility and inherent risks of leveraging loans in such a market.
Exactly. And what really sets this advice apart is how it emphasizes structured planning, evaluating your personal finances, ensuring you have adequate income, and setting aside savings before you even think about borrowing to invest.
Yeah, so it's essentially about being realistic with your own financial health before diving in, right? Being honest about your income, expenses, and overall stability ensures you're not overcommitting.
Precisely, because if your own finances aren't robust enough, no matter how promising the investment might look, you're steering into dangerous territory. It's like building a house on shaky ground.
Absolutely. And that's why it's crucial to have a clear repayment strategy. Automating payments, earmarking a portion of returns for repayments, and establishing an emergency fund. All these steps ensure that even when times get tough, you're not scrambling for cash.
Yeah, it's really about building that financial discipline and having a plan that stays flexible enough to adapt to market trends. When things get volatile, you know what to adjust. And staying data-driven helps, as opposed to making emotionally charged decisions.
Right. Emotional investing often leads to panic selling or overbuying during rallies, which can, in the end, push you towards default if things don't go as planned.
Exactly. So, in summary, managing loan risks in crypto investing isn't just about picking the right assets. It's about managing debt responsibly, diversifying wisely, and always staying alert to market dynamics and regulatory shifts.
I think it's fascinating how layered this strategy is. It really forces you to think beyond just the potential windfall from a hot crypto investment and instead plan for the inevitable uncertainties.
Absolutely. And it's almost like a reminder that sometimes the promise of high returns can blind investors to the conventional wisdom of risk management. It's like, don't just chase the rainbow without making sure you have an umbrella, right?
Exactly, you need that preparedness and a systematic approach. It really pushes home the point that caution, coupled with smart strategy, is essential in the high-stakes world of crypto investing with borrowed money.
Well said. Balancing ambition and caution might be the only way to enjoy the upsides without stumbling into defaults. And that, in a nutshell, is the art of navigating crypto investments when loans are involved.
Couldn't agree more. It's all about a measured approach, understanding the risks, planning for the worst while hoping for the best, and making sure every move is data-informed rather than driven by emotion.
So here's to smart, disciplined investing. Cheers to everyone out there managing their risks and keeping their portfolios as diversified and resilient as possible.
Cheers! And here's to staying informed and always being prepared. Because in crypto, that's the real treasure.